Welcome back to Retirement Redefined. Today, we're doing something a little different. Instead of talking about one specific tax strategy, we're going to walk through a fictional small business owner's tax return and show you how tax professionals think. When someone hands us their tax return for the first time, we're not just looking at numbers, we're asking questions. We're looking for trends and we're identifying opportunities to have better planning conversations. Joining me today is Jenny Smerud. She's a CPA in California, and she specializes in helping healthcare small business owners focus on tax strategy and planning to kind of move the needle in terms of how taxes affect their bottom line. Hey, Jenny, welcome.
Hey, Carly, thank you.
Yeah. So you ready to dive in and talk through a fictional business owner's return?
Yes, of course. Let's do it.
Okay. All right. I'm going to, for our listeners, I'm going to kind of introduce a fictional scenario and family. So we're going to meet Mark and Emily. They are married filing jointly. They own an S corporation with 14 employees. Their business has experienced steady growth over the last 5 years. Mark manages operations. Emily does the bookkeeping. They have 2 children, and they hope to retire within the next 10 to 15 years. They've recently purchased some new equipment. They give regularly to charity, and they both work with a financial advisor and a CPA. Okay, so before we even kind of like open a return and look at the actual tax forms, what questions kind of go through your mind?
Well, I'm looking at, first of all, what does this business do? How has their growth been? If their retirement horizon is 10 or 15 years, how are they building toward that? Do I see things like retirement contributions? How are they compensating themselves, and what level is that at? And then ultimately, further down the line, we're talking with them about succession. So if their plan is to retire in 10 or 15 years, how might they divest of this business? So, those are the kind of the top of mind questions. And then obviously when we start to learn answers of some of those things, then we dig a little deeper. But those are the high level first thoughts.
Yeah. I was thinking too about, we know in this scenario they have an S corporation. For me, a lot of times that is also a starting point. It's like, what type of entity do you have and why? Like, how did you structure your business, and what were the plans that went into why that was the selection that was made? And you hear some really interesting questions when you do that. The other one I was thinking about was year end. Like, you had a client recently that was relatively new, and they had a fiscal year end, and we couldn't really figure out why. So most people are on a calendar year end. They have December 31st is their tax year. That's the default for individuals. But for businesses, if your business is seasonal, you could potentially choose a different tax year. And so that's an interesting one to see when we have these fiscal year clients is, why is that tax year what it is? How is that decided? Does that make sense for the industry and the business that you run?
And it ends up, there's some opportunities potentially if that's not really how they need to be. So this was an interesting one related to the R&D credits and how to handle the new R&D credit deduction rules. But we're definitely looking at structuring. In some states, you have to be structured a certain way to do, be in a service industry, perform medical services or veterinary services. So we have to look at all that and help analyze that.
Yeah. So let's say you kind of met with the client. We hear a little bit about their business anecdotally, and then you open up the return. Where do your eyes kind of naturally go if you're looking at that business owner's tax return?
So talking about how they're compensating themselves is a big topic. So, I mean, the reason that you would be an S corporation is, if you have 14 employees, then you're leveraging the employees' work, and you don't have to take all of the profit of the business as self-employment income like you would if you were not incorporated. So a business like this, our fictional business, I would be looking and making sure that the owner's paying themselves a fair market wage. That's important, and IRS requires that. But beyond that, you don't have to take everything in the form of a wage. So this is why you would make the decision to go from a sole proprietorship to a corporation. So we always have that conversation. depending on where they are in their business life cycle, that can change. If they're a brand new startup, there's not a lot of cash necessarily to pay 14 employees and a business owner. If they're nearing, midlife or looking toward retirement, then we want to make sure that we're being efficient with the shareholder wage. So I'm definitely looking at that. And then, this fictional scenario, we have someone 10 years, 15 years from retirement. I'm definitely looking at retirement plans. So, do we have enough profit that the owners are really maximizing what they can do with their retirement plan? Do we have a profit sharing component on top of the retirement plan? Are we thinking about cash balance plans? Especially as an owner gets closer to retirement vis-a-vis their employees. If they have, I'm thinking of a veterinary practice owner. If they have younger employees and they're getting close to retirement, then we're looking at those more sophisticated retirement opportunities. So if I don't see a lot of that in a business owner's return, then somebody in this scenario that's relatively close to retirement, I want to see them starting to leverage some of that, those tax strategies.
Yeah. I think you bring up an interesting topic in terms of retirement plans, because in my mind too, retirement plans are something that should evolve as the business grows and changes. And so like what you started with isn't necessarily what you should have by the time you're getting close to retirement. And I think a lot of business owners kind of treat it as a set it and forget it. Like, oh, I set up my retirement plan benefits and then I never revisit what we're doing or the level to which we're contributing. And then the other thing I was thinking about as you were talking is, in this fictional scenario, we have husband and wife who are both working in the business. So there's an opportunity to leverage kind of double the amount of retirement plans, because most retirement plan contributions are based on a per person basis. And so we can look at what you do for the husband and the wife and potentially double the contributions because they're both getting to put money into the retirement plan. So you can be really aggressive as you're heading into retirement to, build up that retirement plan savings for the business owner.
Yes, I think that's really, really key. We spend a lot of time talking to owners about getting those plans set up. And you're absolutely right. The startup, a safe harbor 401k plan, and then as they're growing toward retirement and building profit in the business, and there's some more sophisticated levers that we can pull and really help those owners have tax savings, but also plan for their retirement.
Right, right. And I think, as we're talking about like reading a return, we look at like specific line items on the return, but I also like to kind of take a step back and just look at like what overall tax bracket are these business owners in. So like, let's look at our income level overall and make some decisions based on, what your total tax bracket is and what that means in the business. And for me, like a conversation that comes up a lot of times, I think, as I'm talking to small business owners, is things like they want to buy a piece of equipment or they want to invest in something to kind of reduce their tax bill. And that's a really meaningful conversation to have in the context of understanding total income and what tax bracket you're in. Because when we talk about deductions on a return, if you have business expenses or write-offs, those are not dollar for dollar tax savings. So if you're in the top tax bracket, which is 37% federally, for every dollar you save in taxes, you get a 37-cent write-off or tax savings. That 37 cents tax savings is great. It kind of subsidizes the cost of the equipment or whatever thing you're investing in inside of the business. But, you're still out 63 cents on your dollar. And that's a conversation I have with clients a lot is, hey, if you're doing this just for tax purposes, then it probably doesn't. That's not the reason why you should be making this decision. That investment should grow your business or take you kind of to this like next step in what the business is doing that you couldn't otherwise do without it. Because if it's just for the tax savings, that you're out economically, you're out more cash than what you've got back. And so I feel like, we can have lots of conversations about tax strategies, how you maximize retirement, what equipment you invest in. Maybe we look at Augusta rules, or maybe you own the real estate and we're looking at self-rental strategies. But all of those things only make sense in the picture of your total portfolio, not just, well, I wanted a tax write-off, so that's why I bought that in my business.
Real quick, if you're listening and you're starting to connect this to your own situation, that's exactly why we have these conversations. These are the kinds of things that we're here to help you through. So if you ever want to talk about it, we're happy to connect. You can reach us at hello@fiatwm.com, or you can go to our website, fiatwm.com. All of this information is in the description of the episode. All right, let's jump back in.
No, I think that's a really, really good point. And the other, we're a very tax planning focused firm. We really put a huge emphasis on tax planning. And so the second half of the year, we're done with compliance season. Now we're into planning season. These are conversations that we really enjoy having with clients, because there's different timing opportunities. So if you know that you need that, ultrasound machine, but you had a down year because, you took some time off, then, we're looking at trying to make those decisions and timing to get the most bang for your buck if you're spending money and trying to get the tax savings. So there's looking at those tax brackets and thinking about timing, because really ultimately tax, it's really just, it's timing. It's all timing. So having those conversations with us or your CPA, and looking at the current year, what's happening next year, and then timing those decisions matters as well.
Yeah. I think honestly, that's one of my favorite things to do in planning, is to just get to hear from the business owner about where they want their business to go, where they're trying to take it. Because you're right, the taxes really it's all timing. So then we get to say, how do we marry the tax code or the timing with this kind of strategy that they have, or the vision that they have for their business? And it's kind of a fun way to partner with business owners, where, they get to be the visionary, say where they want to take the business to go, and we get to figure out how tax strategy can support that vision. I actually was talking to a business owner client yesterday, and she just opened a second location. It's a medical practice. They're needing to buy a new laser. This laser is like over $300,000. And at the same time, we were talking about maybe putting their car in the business, because now she has the second location. She's driving between the two spots. But buying a car was going to be an expensive investment, and this laser that's over $300,000. And so that kind of conversation about, should we do it all in 1 year? Do we spread it out? We talk a lot, or there's kind of on the news a lot, this thing about bonus depreciation, which basically is when you buy a big piece of equipment, you have the option to either deduct that equipment over time, it's generally like 5 or 7 years, or write it all off in year one under bonus depreciation rules. But for this taxpayer, if we were to write off, if she bought the equipment and the car all in year one and we took bonus, she'd get down to zero of taxable income. And that's an interesting play too. So a lot of what we talk about is not having kind of peaks and valleys in income, and being able to stay kind of in the middle. So if you have 1 year where you're in the 37% tax bracket, and the next year you drop down to zero, you actually end up paying more in taxes than if we had kept you like in a 24% tax bracket both years. And so kind of playing this long-term strategy game of how do we mitigate taxes over a longer period of time, and not just in any 1 year. And I think it's really enticing for business owners to want to just get down to zero. Like, I bought this big piece of equipment. Let me just write it all off in year one. I'll have no tax bill. How nice will that be? I don't have to pay the government anything. It feels really good. But if we actually run the math on the dollar spend, they spend more over time having those peaks and valleys.
Yeah, that's true. And that speaks to also how we try to partner with business owners throughout their business life cycle. So the very first year that you're doing, let's say we have a startup veterinary practice, you have all these equipment purchases. It's very rare that I would recommend that we would take bonus on all of those brand new equipment purchases in the very first startup year, because you're going to be growing. You just started. I mean, there's some examples, and those are all strategies there's some cool strategies we can do if that's what we can take advantage of them. But I think looking at where the business is at, and then absolutely keeping things in a growing business, keeping a steady tax bracket and making those timing decisions. And it really is the stroke of midnight kind of timing decision. Do we place it in service, on 12/31 or 1/1? And it does matter. And there's some pros and cons to those decisions.
Yeah. Yeah. No, the timing conversation is, it's a really interesting way to kind of think about things, which one of the things we didn't talk about earlier was, evaluating a business was, cash versus accrual. And that's a piece of kind of this timing discussion as well, which is how and when do you recognize income, and when do you get to take your deductions? So I would say, I mean, the majority of our small business clients are cash. Jenny, do you want to kind of just briefly talk through like what's the difference cash versus accrual and what that means for timing?
Sure. Yeah. So a cash basis taxpayer gets a tax deduction and recognizes taxable income when they receive the cash or pay the bill. It's pretty simple. For I think Carly, I mean, for most of our clients in the healthcare space, it's cash basis for a variety of reasons. Accrual basis taxpayer, um, they're keeping track of accounts receivable, accounts payable. They're probably a little larger, have a gap financial system, and they're accruing an expense when it's due, but not necessarily when it's paid, or taking income into their P&L when it's earned and not necessarily when they actually receive the check. There's pros and cons to both, and there's industries that should choose one or the other. So it's a very important decision. But yes, it's a very different way of looking at your income and expense and timing.
Mm-hmm. Yeah, I like to highlight that because there is, as you just mentioned, there's certain industries that it makes more sense to be one versus the other, but there's also the option to change. So as we're talking about planning, you can file some additional forms with your return that make an election change to say, I'm going to change from one method to the other. Some businesses have to do that as they get past a certain size. Most small businesses choose cash. I like cash because it's tied to what's in your bank account. So as the business owner, you pick up income when you've received the funds and you get a deduction when you've paid the funds, and that's tied to how much money you should have on hand. And so it should be a little easier to kind of marry, at least even like psychologically, when you have to think about like, here's my tax bill, to marry that to the cash that's in your bank account versus someone that's accrual basis that, maybe is paying taxes on income that they haven't yet received. And so I think that's sometimes harder for a small business owner to kind of get their head around. So that's why I like it. But there's definitely reasons why we would consider changing, or you might have to change as your business gets to a certain point. But I like to think about that as well. Because again, if taxes are about timing, then the timing of when you recognize your income and when you get your deductions also matter. And as you said, like, for buying a piece of equipment, it's not just when you buy it. In that case, it's also when it's placed in service. So then we're looking at timing of, when was that equipment actually received and operational? And it goes to this whole picture of how do we think about your taxes inside of the business, and then how do those taxes affect you? Which that was another kind of piece that I thought we should talk about, which is, you brought up, W-2 wages for compensation for these small business owners, and looking at a strategy where we evaluate, what you take in distributions versus what you take as a salary. That is a really interesting conversation to have with business owners, and I think is also kind of a point of confusion, is that what you pay tax on isn't what you take in distributions. What you pay tax on is the net profit of the business when you have a flow-through entity. And most small businesses are flow-through entities, either partnerships, S corporations, or disregarded like Schedule C businesses. And so for the business owner's tax return, the business owner's paying tax on the net profit of the business. The business itself is not paying any taxes to the IRS. And that's, again, philosophically kind of an interesting spot to be in. The business doesn't have a tax bill. The individual business owner has the tax bill based on what the business made. And so like tracking and understanding your financials is really important, and having financials that are regularly updated so you can do planning, so you understand individually how the business's performance is affecting your personal return. I've had a few business owner clients that came to me and they're like, tracking things in Excel. They get to tax season and they've got to pull together all of their business activity and their income and their deductions, and they don't really have a sense of where they are throughout the year, which makes it really hard to do planning. And it does feel like then kind of every year is a surprise, because you get to tax season, you're like, oh, how did the business do this year? I don't know. And that's not necessarily tied to what you take in distributions.
Yeah, not at all. No, you're going to pay tax on the profit, and you can take the cash out or not. And so, yeah, being aware of really how your business is performing on a real income statement cash level is super important, and it all comes to roost in your individual return on those pass-through entities. So that's another reason why, our focus on planning is really important, and just making sure that that stuff is all current so we can help you make those decisions at the end of the year, because it will matter in April.
Yeah. Yeah. And I mean, I think the other thing I would say is, um, if you're a business owner client, like being not afraid of an extension, and like the fact that an extension can actually help you as a business owner client, because you have one more time to make some decisions about like how do all these different things interplay on your return. So maybe you are making a decision about whether you take bonus depreciation on that new piece of equipment or not. It also gives you more time for making retirement plan contributions. So you can get the tax write-off for making profit sharing or cash balance plan contributions for the prior year, but you don't have to put the money in until the due date of your returns. If you file an extension, you've extended this period of time for cash flow purposes where you have, additional 6 months to contribute to your retirement plan. And we have like a large majority of our business owner clients file an extension every year just for that, just for the extra 6 months to make their retirement plan contributions, because
It's a
it helps with
huge
that
thing.
cash flow and timing.
Yes.
And that's a unique one that kind of goes against all the rules we just talked about of like, hey, you get the deduction when you pay the cash. This is like an exception to that rule. And so I think that sometimes this idea of an extension feels scary, or like, a business owner's doing something wrong. They didn't have their stuff together, or now they're late, but they're not. There's actually, like, again, this is a really purposeful strategy to file an extension to get that extra time on the retirement plan. And then when all those numbers come together, you can make some final decisions about like, okay, are we still going to elect bonus, or should we spread that out over 5 years? What do we want to do on the retirement plan? Maybe we need to look at a cost segregation study on their building, and it gives you time to kind of think through all of those things, which I really like. And I think being a business owner is about, it's not just about like checking the box and saying like, yes, the compliance done, so the return is filed, but like, how did you leverage all of that strategy that's been put in place? And so pausing a moment and taking the time to do that. And I think extensions really allow business owners that space.
Yes. I mean, we were talking about cash versus accrual, but that's like kind of one of the only strategies that as a cash basis taxpayer, you can defer. You can keep the money in your bank account, and make the retirement contribution later in the year. And there's many, many clients that we work with that's a real cash management strategy. Mm-hmm. So that's important.
Yeah. I think as we're also talking about business owners and kind of strategy, one of the other things I was thinking about for them is, there's kind of like a list of deductions I would say that clients can regularly come to me about because they're unique or they have specific like carve outs in the tax code. And I thought we should just name them. We don't have to like go through like all the rules around each one, but it is helpful to kind of understand, because in general, what you can write off in your business, is what's ordinary, necessary, and reasonable for a business expense. And that the idea of that is that each industry is a little different. So what's a reasonable expense in one business might be different for a reasonable expense in another business. But we're looking at these kind of overall, if it's a business expense, it's generally a write-off on your tax return. But there are some carve-outs around that, like meals, for example, which are only 50% deductible, or entertainment. So you could take a client out and, go golfing. That's a business expense, but the IRS sees that as entertainment and it's non-deductible on your return. So there's just some interesting like planning things to consider, or that business owners should just know about, that like, hey, if you choose to spend your money on that, you're not going to get the same tax write-off as you would in another area. I was thinking about things like vehicle expenses. Putting your car in the business is a common one that we get a lot of questions about. I would say, come talk to us if you're looking at putting your car in the business, because there's a bunch of rules and things you have to do, but really you've got to track mileage, track what you're using the car for personally and what you're using it for business. And really, if you can't hit this threshold of over 50% business use, then you really shouldn't put your car in the business. But that's one. Home office deductions, paying your kids in the business. I mean, there are a bunch of different tax strategies for how we can say, hey, now that you're a business owner, we can look at what deductions we pick up in your business that can help save you in taxes. But it really makes sense looking at the whole business overall, how your operations are structured, what industry you're in, and then look at how we leverage and take advantage of some of those. But I feel like home office deduction, kids in the business, and probably vehicle in the business are the ones that I like talk to the clients about the most.
Yeah, I agree. Those are three things that we want to understand when we pick up a business owner return. And there's opportunities and very real opportunities to save tax in some of those areas, but we have to.
Yeah. And some of those areas, like, they might carry a little bit of risk. So in my mind, our job is to say, okay, well, here's the documentation you would have to provide if you ever were in an IRS audit and they were asking you questions about that deduction. Here's the support that you would need. Here's maybe risk that you carry and how you can mitigate that risk. And then you as the business owner can kind of decide what actually makes sense for your business with our guidance. Yeah. Okay. What about, is there any time where you've kind of looked at a return and thought through, hey, something, maybe instead of seeing something that was on the return, that you noticed something maybe that's missing off of a return, or like things that kind of triggered like, hey, I'm surprised that that's not on there. Have you ever had a client where you're looking at that return and see anything like that?
Yeah, well, I mean, we're always looking at making sure there's some really specific rules about shareholder health insurance. That's not always handled properly. So that's
the one that stood out to me too.
That's a common error, either on the entity level or the individual level. That's the big one. I mean, that I find a lot of errors on when I just first pick up a new S Corp return, because it's not always done correctly.
Yeah, I would say that too, specifically for S corporations.
Yes.
Maybe not for the other entity types, but S corporations specifically have some unique rules for how health insurance is reported and deducted for business owners. So if you have an S corporation, you should check in. There's some special reporting on your W-2, special reporting inside of the entity, and then on your personal return.
That's right. It's really nitpicky too, and you have to do it on your W-2 at your end, and it's a common problem.
Yeah. There are some interesting things in tax code where if you just like administratively, if you just didn't like check the right box, then you're like, oh, you just lost that deduction because you didn't do it the right way. It doesn't matter. Your business paid for it, all the right things. But if you didn't properly report it or check the right box, then now you've lost that deduction.
Yeah, that's one of them. That's a common error.
Yeah. So, I mean, I hope that our listeners, what they're pulling from this, I hope, is that there's a ton of opportunity for planning, and that planning allows you to look at, again, your vision for the business and how you align tax strategy with that vision so that you're leveraging the tax strategy to get you to where you want to be. And that's really where Fiat, I think that's where we shine, both on the wealth management side and on the tax side, that we're a planning focused firm. And that when we just prepare returns, that's looking backwards at last year and at what happened. And that can tell us a story. It's helpful to understand that story. But planning is where we actually get to look forward rather than backwards and say, what could we do differently to actually move the needle? And so that might be, as Jenny talked about, like retirement planning. It might be cash flow planning, estimated tax payment changes in how you compensate yourself or compensate your family. Or it might be bigger questions about exit planning, succession planning. What happens if the business sells? How do we structure a business sale? What are the tax implications of that sale? And is there anything that we could do to mitigate some of those, some of that tax bill? But really, the goal is not just that we're lowering your tax bill. The goal is that overall, we're making decisions that support your total financial picture and where you want to be in the future, and that we're using taxes to get you towards where you want to go.
Well said.
Yeah. Okay, well, today's conversation wasn't about just finding mistakes on a business owner's tax return. It was about showing you how a tax return can be one of the most valuable planning tools that a business owner has, and that every tax return tells a story, but it doesn't tell the whole story. And that's why asking the right questions and having conversations with your financial advisor and your CPA, all throughout the year, not just during tax season, can really make a difference. So Jenny, thanks for walking us through how you approach reviewing a business owner's return. And thank you all for listening to Retirement Redefined. We hope this gave you a new perspective on your tax return and what it might be telling you. If you'd like to continue the conversation, be sure to connect with your tax professional or financial advisor before making any tax decisions. And we just want to say thank you for joining us on our Fiat Tax Takeover. Be sure to tune in next time when Brad is back behind the microphone. Thanks.
I appreciate you being here. There's always going to be noise when it comes to money. Our goal is to help you cut through it and make thoughtful, informed decisions with clarity and confidence. If you found this helpful, make sure you're subscribed and you stick with us. And if you ever want to talk through your own situation or see how all the pieces of your plan are working together, our team is here. You can reach us at hello@fiatwm.com or on our website, fiatwm.com. Everything's in the description. We'll see you next time.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views and opinions of Fiat Wealth Management. The content has been made available for educational and informational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.